China's yuan is tanking again despite the massive stimulus announced a couple months ago. And of course, at the same time, more record lows for Chinese government bond yields. There is not a whole lot of faith in Beijing's ability to pull China out of its growing mess. And we got more data to show exactly that. There wasn't a whole lot of faith to begin with, outside of stocks anyway. But now that Xi Jinping has pulled out his bazooka and has almost nothing to show for it, it only gets even more difficult from here. And China's hardly alone, of course. Currencies are dropping all over the place. India's rupee, another record low. Brazil's real, they hit a record low too. Korea's won, closer to a multi-year low. The only one going up is Japan's yen, and that's not a good sign. In fact, JPY rising is evidence that some of the world's biggest financial firms, they're not waiting around to see what happens with China or the US for that matter. The latest economic data from the country shows very little for what was sold as the biggest bazooka ever. PMIs were weak for the month of November, particularly for services, which is the primary concern in that real economy. Even the housing market only produced a single monthly bounce before dropping right back into deep contraction in November. So sure, the Chinese government plans on borrowing trillions of yuan. While that may impress economists and reporters, markets have never really bought into it. And now the macro data for November shows that skepticism was more than warranted. Even the Politburo is hiding. Knowing that whatever faith there is in the bazooka is fading fast, and that market participants are desperate for any sign that Chinese officials get it and are finally going to release some details, the top Chinese government body skipped its November meeting anyway. They don't know what to do, not really. It really seems as though they were going to throw out some of these huge numbers, talk about trillions of government borrowing, and just hope the market would do all the work for them. Well, the market isn't doing the work. Instead, the market says, give me something real or I'm going to continue to go safety and liquidity. Government bonds, low growth and inflation expectation. China's yuan tanking in addition to all the other currencies that I mentioned, except for the yen. More global fundamental signals that the world, and China in particular, heading in the wrong direction. But of course, the recent economic data was characterized as mixed. They're selling bad numbers as mixed, as tentative signs of recovery, as if we haven't seen all this before. And I'll give you an example right from the start. Bloomberg, the headline was, China's factory activity expands in sign of slow recovery. But then you scroll down the page a little bit to the chart that shows the PMI data, which I'll get to a little bit further in the video. And the headline for the chart says, China's factory activity shows little recovery, which is actually closer to the truth. So it's not tentative signs of recovery. It's little recovery because it's just nothing more than a fluctuation. We do expect that China's economy will have a short-run impact, that the stimulus will create some limited rebound in certain parts of the economy and certain kinds of activity. But overall, we've seen this time and again before, including in the PMIs. What we haven't seen is the lack of reaction to the services PMI. Again, I'll get to that in just a moment. Instead, first, the yuan. As of today, this morning, despite the announcement this weekend of quote-unquote mixed economic signals and mixed economic data, it really wasn't. And you can tell it wasn't mixed because of the way that the currency is behaving. As of this morning, 727.2 for the yuan to the dollar. That's the lowest since July 23rd of this year when it was 727.48. It's down sharply just today, which tells you everything you need to know about what the PMIs really had to say. At 727.20, that's closing in on the low from last year, November 13th of 2023, which is not all that far from a more than decade low going back to 2008, early 2008, the 730 range. So CNY falling precipitously, heading down toward that level. At the same time, the Chinese government is now back to trying to do something about it. The Chinese government is trying to use the midpoint once again to strengthen the yuan, or at least to try to get the market to strengthen the yuan by fixing stronger than where the actual market exchange value is. And this goes back to the middle of November. November 12th, the CFETS reports that the PBOC fixed the midpoint at 719.27. And then they held it there just above 720 to the dollar, which seemed to be another red line for the Chinese, at least a short run red line, until November 28th, when suddenly they started to fix stronger again as the currency got weaker and weaker in the marketplace. But as I said in the introduction, it's not just China's yuan. China's yuan is sending some pretty powerful signals, but there are others. I talked about India in a video on Saturday. India's rupee hits another record low today at 84.74 for the same reasons, global fundamentals. It's not just China or just India, it's the combination of all of those, plus all of the macroeconomic weakness that's going around the rest of the world. Brazil's real, 607, that's a record low, at least as a closing price. Falling sharply has nothing to do with interest rates. The Brazilian central bank is going to be raising interest rates as the Fed's cutting them, which should be strengthening the real. Instead, it's going the opposite direction, in part because of Brazil being upstream of China, taking some of the heavier impacts from the Chinese economy weakening, continuously weakening. So Brazil is feeling the impact of what's happening in China, and China being upstream of everything else around the rest of the world too. Korea's won, South Korean won at 1406 is right at the same level of multi-year low for largely the same reasons. Macroeconomic fundamentals from the perspective of Asia. The only one that's bucking the trend, pun intended, is Japan's yen. I've talked about that before. It's another sign, especially in the context of all these other currencies, that carry trade unwinding is accelerating again here toward the end of November and into December. And the reason why would be the same reasons as before. Macroeconomic risks and financial risks all over the place. From the United States, which we still haven't escaped the recession question, even though it's, for most people in the media, it's no longer a question. That's not the case to the carry traders. And when you throw on top of that Beijing's dud of a bazooka, the tremendous amount of macroeconomic risk all throughout the rest of the world, especially with Europe rolling over again too. We see this in bond yields all over the place, starting with China. I talked about this in a live video last week. The 10-year now fell below 2% for the first time ever as of this morning, despite the PMIs that were supposedly mixed and supposedly showing tentative signs of stability. No, the government bond market not buying it there either. The 5-year hit a new record lows, down sharply, 1.612%. Even the 2 years, only a basis point above its record low, which was set at the end of April in 2020. Bond market, like the currency market, not buying anything about mixed signals or tentative signs or anything about stimulus, except for the fact that it is missing. But of course, to the mainstream media, what's going on in the government bond market as well as the currency, that's all about central banks. According to Bloomberg, China's 10-year yield dropped past the key psychological milestone of 2% and was at a record low as traders ramped up wagers that authorities would ease monetary policy further to bolster the weak economy. It's not about rate cuts. Investors' enthusiasm about Chinese bonds comes as the latest slew of data from improved factory activity to an entrenched housing slump continues to show an unbalanced recovery in the world's number 2 economy. No, China's government bond market has been rallying since last year. In fact, it's been almost exactly a year, around this early December of 2023. Bond yields have been down almost steadily over the last 52 weeks. And it isn't because the government bond market or bondholders are betting on the PBOC to lower rates. In fact, the PBOC didn't want to lower rates up until September, and the bond market and bond yields were going down anyway. It's growth in inflation expectations. It is flight to safety, which is consistent with lower growth and lower inflation expectations. The bond market is not about the PBOC, and it is certainly not about Beijing and its bazooka because nobody in the bond market is buying that it's going to work. If there was any serious thought that the stimulus would stimulate on anything more than a very short-run limited basis, then bond yields would have risen more than they did, a few basis points that they were up in September heading into October before rolling over through October into November to now record lows again here in December. Just like the currency falling pretty sharply, the market is not buying China's turnaround story, despite what the media characterizes as tentative signs of stability. And you can keep going to other parts of the marketplace. The copper to gold ratio, as of this morning, gold at 26.41, copper at just 4.08. Again, copper not really buying the stimulus either. The copper to gold ratio is barely more today than it was at its multi-year low on November 22nd, when I talked about how that was a comparison to the lows of 2009 and what that comparison actually meant. Even oil prices. Oil prices in the United States, WTI 67.77 today, lower geopolitical premium, but no demand. Oil has a massive China problem. And if stimulus was going to fix China's economy, it would no longer have a China problem, which means oil prices would be roaring ahead, and they're doing the opposite. Brent crude, just 71.637 this morning. So showing signs of gaining traction or an imbalanced recovery, whatever they make, tentative signs of stability, not according to the entire marketplace, especially the key ones, the currency and the bond market. Just a reminder, got a webinar coming up on December 11th. Jim Rickards and I are going to be talking about the future of money and monetary systems. Maybe what it should be, what it could be, how we get from where we are today to where we hope to be down the road. And Jim and I have some different opinions on all of those parts of the conversation. So it should be an interesting discussion about the future of money, looking ahead. Again, December 11th, there's a link in the description for you to sign up. I do hope to see you there. What the government in China reported was the PMI data for the month of November 2024. Manufacturing is the one that caught many people's attention, especially the Shaixin version, which came out just last night. But the official government PMI in manufacturing was 50.3. That's up from 50.1, and it's the highest since April, which is even less impressive than it sounds. And last September, during the stimulus frenzy that happened last year, the manufacturing PMI got up to 50.2, and it made absolutely no difference. There are false starts all over the place. And let's not forget, 50.3 is hardly a robust recovery, which is why there's so much hedging language in all of these mainstream media articles trying to sell you on a tentative recovery or signs of stability when it's really just the normal fluctuations that we see every time, including last year. Let's not forget we did this. Last year, the government was responding with massive amounts of borrowed funds. They're borrowing more this year, but they're doing basically the same type of idea this year that they did last year to no avail. While everybody's talking about improvement in factory activity from the NBS manufacturing PMI, the non-manufacturing PMI went the other way. It had only rebounded from 50, and 50 was the lowest we've seen since the lockdowns in China. It went from 50 in September to 50.2 in October, and everybody said, okay, there's tentative signs of recovery in the more important services part of the economy. Instead, here in November, the PMI falls back to 50 all over again. So again, matching September for the lowest since the lockdowns. No effect from stimulus. In fact, just to make a comparison here, in February 2016, the non-manufacturing PMI had fallen to 52.7 at the bottom of Eurodollar number 3. But because the government had responded with direct spending and massive stimulus, Keynesian approach, all of that stuff, by June of 2016, just a couple months later, the PMI went from 52.7 to 53.7. We don't see any sign of that here because, in large part, the Chinese government doesn't really know what to do. And that's why there's so much widespread skepticism. There's no sign of tentative recovery, and there's no sign that the government knows what it really wants to do to try to get China out of this mess. Apart from the PMIs, the 100 largest realtor firms in China reported on housing sales, the market value of housing sales in November. There had been a rebound for the first time in a long time in October after the initial stimulus announcement, including aid to first-time borrowers and all sorts of measures aimed at boosting home buying and more housing activity. There was a rebound in October. In fact, the value of houses sold, according to the 100 largest realtors, increased by a 7.1% year-over-year rate in October. But it didn't last. In November already, that's fallen back into a minus 6.9%, minus 6.9% year-over-year in November. And in the month of November alone, the value of home sales dropped 16.6% from October. So there was only the 1 month turnaround in terms of the value of housing sold, and it was just October, just the immediate aftermath of the announcement effect from the quote-unquote stimulus, and it didn't last because it was nothing more than a sentimental tactic to try to get people to buy into the idea of stimulus and therefore become the stimulus. And that's the most that we've seen, just this 1 monthly increase in home sales. And you can argue that even the manufacturing improvement, the PMI up to 50.3, that isn't even really about stimulus. That's more about China dumping its excess production on the rest of the world, running their factories hotter than they normally would to sell overseas, as well as how much of that production is to get ahead of the impending tariffs from the Trump administration. So even the factory improvement may not even actually be a sentimental thing. It's just a one-time quirk, which is bringing forward demand that the Chinese economy is going to have to pay for down the road. And that's kind of where you get to where the market signals are going. So you would think that the Chinese government would be all over this. We've got this plan. We're going to put it together. It's going to be huge. It's going to be great. Let me tell you all about it. Reassuring the public, the markets, and everyone else that they know what they're doing. And instead, the Politburo skipped November. No readout from the government body at all. As Bloomberg said, Beijing is struggling to arrest the decline in the property sector with deflationary pressures adding to the economic gloom. And investors are expecting more policy support so China can meet its economic target of around 5% this year. But investors who remember last year's conference might temper their expectations. That huddle, which was held from December 11th to 12th last year, amounted to a letdown for those seeking signs of greater stimulus, with top leaders instead pledging to make industrial policy the main economic priority, which didn't have any impact on China's economy in 2024. Instead, the stimulus ferry keeps getting pushed further and further into the future. Meanwhile, the tentative signs of recovery are entirely too tentative, and they're entirely too familiar because we've seen all of this before. So China's currency continues to plummet because the fundamentals of China have not changed. There was just a brief detour on sentimental impacts alone, although piggybacking on the yen carry trade for a while there. But more importantly, government bond yields as well, and the rest of the marketplace, record low bond yields, low growth and inflation expectations, and the market is not buying China getting out of this mess. Like I said, we've seen this before. According to Western media, anytime you see a positive number, no matter how small or insignificant, they're always saying that China has turned a corner. Remember that from last year, the stimulus frenzy last year, the euphoria? China's turned a quarter. That was the reports on September and October data, and then it all just disappeared heading into the 2024 this year. Tentative signs of stabilization that aren't really tentative, nor are they stabilization. The PMIs themselves don't really show that. We've got a temporary increase in manufacturing activity, which is more likely tariffs and dumping than stimulus. There's been no impact on the services sector, which is really important because that's where the biggest economic trouble is inside of China, a direct fallout from the real estate sector. And even in the real estate sector, housing only got the 1 month, a one-monthly rebound, and all it did was burn a ton of people who bet on a turnaround, and that will be remembered across the marketplace. So again, CNY falling, especially with all the other currencies around the world, this is China's contribution to globally synchronized. So while Yuan continues to fall, Japan's yen continues to rise. And I talked about what that means in a recent video, so one link below. As always, thank you very much for joining me. Join me on December 11th for the webinar with Jim Rickards. Huge thanks to Eurodollar University members and subscribers. And until next time, take care.